In this chapter, we are going to talk about the earning per share. The earning per share is a very important indicator for the investor. When the investor needs to determine the profitability of the company, he needs to compute the earning per share. The earning per share is the net income over the weighted average number of shares outstanding during the period. But before we will talk about determining the earning per share, we have to determine the components of the classes of stocks that affect the earning per share. Now, we need to determine two types of earning per share: the simple or basic earning per share and the dilutive earning per share. The basic earning per share will be determined when we have simple capital structure. Simple capital structure means that we don't have convertible stock, bonds or preferred stock. In this case, we have simple capital structure. But when we have complex capital structure, which means that we have either convertible bonds or convertible preferred stock, or both of them, so in this case we have complex capital structure, and we have to determine, in addition to the simple capital structure, the dilutive earning per share. Also, we will talk, before we determine the earning per share, we will talk about how to record the conversion of convertible bonds and convertible preferred stock into common stock. Now, why the investor is encouraged to buy convertible bonds and convertible preferred stock, and why the company issue this type of stock? The investor will buy the convertible bonds and the convertible preferred stock because he is going to wait until he determines the profitability of the company. When the company is successful and the common stock achieved high rate of return, so in this case the investor will be encouraged to convert the convertible bonds into common stock, and the convertible preferred stock into common stock. Now, why there are two reasons the corporation issue convertible bonds or convertible preferred stock. The company may desire to raise capital without giving up control over the ownership control than necessary. And also, it can obtain common stock financing at cheaper rates. Now let's take this example. A company issued 4 million par value 7% convertible bonds at 99% for cash. If the bond had not included the conversion feature, they would have sold for 9.5. Now the entry at the time of issuing will say, and we studied this before, debit cash for 3,960,000, which is the 4 million times 9%, and the debit discount in bonds, which is the 1% of the 4 million, credit bonds payable. Now let's take this example. A company has outstanding $1,000 bonds, each convertible into 50 shares of $10 par value common stock. The bonds are converted on December 31st, 2010, when the unamortized discount was $30,000 and the market price of the stock is $21 per share. In this case, the general rule is to, at the time of conversion, is to close all the accounts for the bonds. We have bonds payable, credit for 2 million, and we have discount on bonds debit for 30,000. We have to close these two accounts. So we say debit bonds payable, credit discount in bonds for 30,000, bonds payable debit for 2 million, and the discount in bonds credit for 30,000 in order to close all accounts of bonds at the time of conversion. Now, we have to substitute the bonds for the common stock converted. So we say credit common stock by the par value of stock, 2,000 bonds. Every bond will be converted into 50 shares common stock. The par value for every stock is 10. So the total is 1 million. Common stock 1 million credit. And the remaining amount will be in the credit side. The difference will be in the credit side, will be added to additional paid in capital. Now we will talk about the induced conversion. The induced conversion means that in order to encourage the holder of the bonds to convert them into common stock, so we offered them an additional amount of money. We call it induced conversion, and we will take example to explain that. Now let's take this example. It's the same information in the example before, except that the company, to encourage the bondholder to convert the bond into common stock. So in this case, the company agreed to pay the bondholder $70,000 to convert. In this case, we will record the same entry before, which is the debit bonds payable, 2 million, discount in bonds credit for 30,000, common stock credit for 1 million, additional paid in capital by the difference, which is 970,000 credit, and we have to record the conversion expense, which is the amount, the additional amount paid to the bondholder in order to convert their bonds into common stock. So we say debt conversion expense debit for 70,000, credit cash for 70,000. Now we will talk about convertible preferred stock. The same fact as in the conversion of bonds into common stock, the conversion of preferred stock into common stock will be the same. The holder of preferred stock has the right to convert their preferred stock into common stock. So the preferred stock is considered part of the stockholders' equity, and no gain or loss from recognition of the conversion of preferred stock into common stock. And in this case, we will apply the same facts as convertible bonds. We have to close all accounts related to the preferred stock, and then we substitute the new common stock, new issue of common stock instead of the preferred stock. Now, this example will explain the idea of conversion of preferred stock. The company issued 2,000 shares of $10 per value common stock upon conversion of 1,000 shares of $50 per value preferred stock. The preferred stock was originally issued at $60 per share. So in this case, we have two accounts related to the preferred stock. 50,000 par value, 1,000 times 50, which is the credit, and the additional paid-in capital for preferred stock, 10,000, which is 1,000 times 10. And these two accounts are credit. So in this case, in order to close them, we will debit them. Preferred stock debit for 50,000, paid-in capital debit for 10,000. In this case, we closed all accounts related to preferred stock. Now, instead of the preferred stock, we issued common stock. The common stock, 2,000 shares, $10 per value, so 2,000 times 10, 20,000. And the difference between the debit and the credit will go to the paid-in capital common stock. Now, notice that in some time, the difference will be in the debit side. In this case, we don't recognize loss, but we say we'll debit to retained earnings. That will be debit retained earnings, not gain or loss from conversion. Now we will talk about earning per share. We said before that the earning per share is calculated by dividing the net income for the period over the weighted average number of shares. And we have to differentiate between the simple structure, the simple capital structure, and the complex capital structure. Simple capital structure when we have only common stock. So in this case, we don't have any convertible bonds or convertible preferred stock. But if we have convertible bonds or convertible preferred stock, so in this case we call it complex capital structure, and we have to determine what we call dilutive earning per share. Means the ability to influence the earning per share, the basic earning per share, in a downward direction. Means that the diluted earning per share will be lower than the basic earning per share. So the basic equation to determine the basic earning per share is to, as we see, earning per share equal to the net income minus preferred dividend, the dividends that will go to the preferred stock, over the weighted average number of shares outstanding during the period. This is the equation to determine the basic earning per share, or the simple earning per share. We call it basic earning per share, equal to net income minus preferred dividends that will go to the preferred stock. So the remaining net income will go to the common stock. Net income minus preferred dividends over the weighted average number of shares outstanding. Now, in order to determine we know that the basic equation to determine the earning per share is to divide net income minus preferred dividends over the weighted average number of shares. The weighted average number of shares is calculated by taking any kind of transactions that affect the common stock amount during the period. So in this case, we have to take any type of transactions related to the common stock, like issuing for common stock, buying treasury stock, reissuing treasury stock, stock split, stock dividends. And you notice that when we determine the weighted average number of shares, we weight the shares by the fraction of the period that the common stock outstanding. And when we have stock dividends or stock split, we have to assume that these transactions, stock split or stock dividends, occurred from the beginning of the period. Even if the stock split or stock dividends occurred during the period, we have to assume that it happened at the beginning of the period. And this will be explained by the following examples. This example will explain how to determine the weighted average number of shares. On January 1st, 2010, a company had 480,000 shares of common stock outstanding. During 2010, it had the following transactions that affected the common stock account. On February 1st, issued 120,000 shares. On March 1st, issued a 20% stock dividend. In May 1st, acquired 100,000 shares of treasury stock. In June 1st, issued a 3-for-1 stock split. On October 1st, reissued 60,000 shares of treasury stock. And we would like to determine the weighted average number of shares for this corporation. Now, in order to determine the weighted average number of shares for the last example, we have to prepare this table. The first column in the table is the date for transaction. The second, the change in the number of shares. The third column, the shares outstanding, number of shares outstanding. Multiply this number times the fraction of the year. And then the restated for the stock dividends or stock split. And then determine the weighted average number of shares. Let's take the first line to explain the idea. On January 1st, we have outstanding 480,000 shares before February 1st. So January and February, so this is 1 month. 1 month, just 1 month. So we multiply 480,000 times 1 over 12. And we have to restate this amount by both of the stock dividends and the stock split as if this transaction occurred from the beginning of the period. 20% dividends means that we multiply the amount times 1.2 or 120%. And the time 3-for-1 split factor times 3. So the weighted average for this amount is 144,000. After that, in February 1st, we issued 120,000 shares. So the amount becomes 600,000. This amount remains for 1 month, from February until March 1st. 1 month. So we multiply this amount times 1 over 12 and restate this amount by the stock dividends and the stock split times 120% for stock dividends and the 3 for stock split. So the weighted average will be 180,000. The third line. In March 1st, we have added 120,000, which is the stock difference, 120,000 in addition to the amount before, 600,000. So we have total 720,000. This amount remains for 2 months, times 2 over 12. In this case, we have no stock difference. Stock difference occurred before. So we multiply this time the split factor, because the stock split occurred in June 1st. So in this case, we have to multiply this amount times the stock split factor. So the weighted average number of shares for this amount is 360,000. In May, we acquired treasury stock for 100, so the amount becomes 620. 720 minus 100, 620,000. Remains for 1 month until June 1st. So time 1 over 12. Multiply this amount by the split factor only, 3. So the weighted average is 155,000. After that, in June 1st, we did the stock split 3 for 1. So the 620,000 times 3. So the amount becomes 1,860,000. This amount remains from June 1st to October 1st, 4 months. So time 4 over 12. Now the stock difference and the stock split occurred before, so we don't restate for both of them. Time 4 over 12, 620,000 weighted average. At October 1st until at the end of the year, we issued new 60,000. So 1,860,000 plus 60,000. To talk about the complex capital structure when we have convertible bonds or convertible preferred stock, and we will see the effect of this on the earning per share by calculating the diluted earning per share. We said before that when we have convertible bonds or convertible preferred stock, this means that the bondholders and the stock and the preferred stockholders can convert them into common stock. What is the effect of this on the earning per share? Now let's take the convertible bonds. What is the effect of convertible bonds on the earning per share? In order to determine the effect of convertible bonds on the earning per share, we have first to determine the conversion of at the beginning of the period, if the bond issued at the beginning of the period, or at the time of issuance if the security of the bonds issued during the year, and also to determine the effect of on the interest by eliminating the interest. In order to determine the effect on the earning per share, we have to determine the number of shares if the bonds converted into common stock, and the effect on the net income by eliminating the interest, because if you convert the bonds into common stock, there is no interest, but they will receive dividends as common stock. Let's take this example. In 2010, the company issued at par value $1,000 per 8% bonds, each convertible into 100 shares of common stock. The company had revenues of $17,500 and expenses other than interest and taxes of $8,400 for 2011. Assume that the tax rate is 40%. Throughout 2011, 2,000 shares of common stock were outstanding. None of the bonds was converted or redeemed. In this case, we need to determine the diluted earning per share for 2011, and second, as we will assume that the bonds issued in September 1st, 2011. Now, in order to determine the diluted earning per share, we will calculate first the net income. Net income is determined by taking the revenues, $17,500, minus expenses, $8,400, minus the bond interest expense, $7,500 times 8%, $6,000. So the income before tax, $3,100. Minus income tax expense 40%, so the net income will be $1,860. Now, we have to determine the basic earning per share. The basic earning per share is the net income minus preferred dividends. We don't have preferred stock, so there is no preferred dividends, and the net income will be 1,860 over the weighted average number of shares during the year 2000. So the basic earning per share is 0.93. Now we have to determine the diluted earning per share. The diluted earning per share, we will take the equation for the basic earning per share, and to see the effect of converting the bonds into common stock. So the net income will increase by eliminating the effect of interest. The effect of the interest usually determined by taking the interest, 60,000, times 1.4 is the after tax, the tax expense 40%, so the interest after tax will be 60,000 times 1 minus 0.4. And also we have to increase the number of shares, weighted average number of shares, by assuming that all the bonds will be converted into common stock, 7,500. So the diluted earning per share will be 5. Net income 5,460 over 9,500 shares outstanding. So the diluted earning per share will be 0.57. So the requirements number 2 is to determine the diluted earning per share, assuming that the bond issued on September 1st, 2011. In this case, we have to calculate the net income. Revenues, 17,500, minus expenses, 8,400, minus the bond interest expense, which will be 75,000 times 8%, times 4 over 12, 4 months from September 1st until December 31st. Will be 2,000. So the net income after tax will be 4,260. Now the diluted earning per share will be, as we calculated before in requirement number 1. The net income will be 4,260. We will add the interest expense plus 2,000 times 1 minus 0.4, and we will add the number of shares issued from September 1st, which will be 7,500 times 4 over 12. So the diluted earning per share will be 1.21. Now we have to determine the diluted earning per share in case we have convertible preferred stock. So in this example, the company issued 40,000 shares of 6% convertible cumulative preferred stock, $100 per value. Each share is convertible into 5 shares of common stock. The net income for 2010 is 1,200,000. There were 600,000 common shares outstanding during the year. There were no change during 2010. So in this case, we need to determine the diluted earning per share. So in this case, we have to determine first the basic earning per share. The net income, 1,200,000 minus the preferred dividends, which is 240,000, 40,000 shares times the par value 100 times 6%, 240,000, over the weighted average number of shares 600,000, so it will be 1.6. Now the diluted earning per share in this case, we have to remove the effect of the preferred dividends if the preferred stock converted into common stock, there is no preferred dividends, and the number of shares will increase by 200,000. So the diluted earning per share will be the net income 1,200,000 over 800,000 shares, which is 600 plus 200. So 1,200,000 the net income over 800,000. We removed the effect of the preferred dividends by adding back the preferred dividends. We subtracted in basic earning per share, we subtracted 240, so we added it back, and this will remove the effect of converting the preferred stock into common stock. So the diluted earning per share in this case will be 1.5.